Welcome to the Possible Promise podcast, where we break down the complexities of finance and point the way to financial success. Today is August 7th, 2020, and I am your host, Brandon Oliveras.
And I'm his wife, Christine.
This is episode 15, Investors versus Traders. Welcome everyone to our podcast. Thank you for joining us on this very lazy Friday. Christine should have said sleepy Christine.
Yeah, but I don't know.
So not too much going on today. Even in the market, it's kind of quiet today, so it's been an interesting day. A couple things first. Unfortunately, we had to postpone our guest that we had scheduled for Friday. It just didn't...
For today.
For today, I know.
You said for Friday. Today is Friday.
Yeah, well, I wasn't wrong. It just didn't work out. We're going to do it in the future, or near future, in a couple weeks. He was going on vacation, and we couldn't find a good time to do the recording. So, unfortunately, that didn't work out, but it is still scheduled, for some point. So, probably in the next 2 weeks or so, I'm hoping. So that we can look forward to.
So you have us to entertain you.
Yes. And again, if you want to chat with us or just, ask a question or anything else during the podcast, whether you're listening live or whether you are listening later on to the recording, you can tweet us at Possible Promise, all one word. And I will get that, and will do my best to respond, whether live or directly on Twitter. We'll see, depending on when you do it. So, with that, we'll get into what's going on. So this has been an interesting week. Like I said, the markets are kind of indecisive where they want to go today. It started out low this morning, and then it's been kind of mixed today. Even though, and I'll talk about this soon, there was a positive economic report this morning with unemployment and everything else. So, but
was there?
There was, yeah, and I'll mention that in a few minutes during our week in review. But there's also still a lot of uncertainty about the stimulus bill and everything like that. We don't really know when that's going to happen yet. The market is sort of trying to stay optimistic, but it's just very quiet right now, I think, overall. So,
it's hard when you just don't know what you're doing or what to do.
Yeah, so it's just been, it's definitely been an up week, but today overall it's been pretty quiet. So I think that we will just have to get into our weekend review. Alright, week in review. So this week has been rather interesting. Oh, I did forget to read where we are index-wise today, so sorry about that. So right now the S&P is down only about 11 basis points, only a couple points. The Dow is down about 41 points. And the NASDAQ is actually down a good bit today, down 109 points. Almost a full percent. So that's actually pretty surprising. The NASDAQ is down about 1% today, which is good news for me, although not enough good news, because I shorted the NASDAQ and it's blown way past my limits. So, and the VIX is down almost 2% today. It was up earlier, and then I don't know, just decided to go down.
Just for you.
So I don't care about the VIX, but it's just interesting. Anyway, but for the week as a whole, I just want to, and I wrote a little script this morning actually to make this a lot easier for me, because I realized, I realized I wanted to talk about where we are as far as the week is concerned. Obviously, the day's not over yet, but I don't think this will change very much. So the S&P this week is up almost 75 points, or 2.3%. This is just 1 week.
Wow.
The Dow is up over 900 points this week.
This week?
3.4%. We're over 27,000 now in the Dow. The NASDAQ, despite today's down move, is still up almost 250 points, 2.3% as well. So, and the VIX is down but 9% for the week. So it's been
You just don't know.
still a very bullish week, and I'm kind of curious where that'll put us for next week, just because, I mean, this is going to be, I don't remember if last week was up or down, but it's just been going up so much. In fact, the RSI for the S&P, I just was looking at this yesterday or the day before, is higher than I've seen it for a while, for at least over a month. Almost 68 RSI for the S&P, so that's pretty high, considering everything going on. So, it's just a lot of stuff going on. If the stimulus comes through, I'm sure that will add to the rally. If it doesn't, then who knows?
If it doesn't, it's probably going to mess everything up.
Yeah, I don't know what's going to happen. I know we will have one at some point, but it's just a matter of when. The unemployment, the $600 amount that people were receiving every week has disappeared.
Didn't it end?
It ended, yeah.
Yeah.
And they haven't replaced it yet. So it's kind of...
They weren't going to.
They're going to replace it with something. At least $200 is the idea right now. But we just don't really know what's going to happen with that. But people are, without that $600 extra, it's kind of hurting people. A lot of people, obviously. So it's not a pretty situation. But that brings me into our economic data. Let me see where it was. Here it is. So the most important ones yesterday, we had jobless claims. So initial claims were better than expected at 1.19 million, still a lot, versus 1.4 million. So the initial was like people who are just for the first time filing for unemployment.
Oh, wow.
The continuing claims, which is, repeated weekly claims, is also down, but still pretty high, 16.1 million versus the 16.9 million expected. So better than expected on both counts, but still, 16 million every week.
Yeah.
That's still kind of high. Today we had what they call non-farm payrolls, so just basically how many jobs were added this or last month. And so for that, it was also better than expected, an addition of 1.76 million jobs versus an expected 1.48 million. So better than expected. And unemployment from last month, also better than expected, at 10.2% versus the 10.6% expected. So that's kind of a highlight of the economic data for this week.
I wonder why it's better than expected.
It's just every month they try to estimate what they think it's going to be, and what do you mean by why?
No, it's just, I don't know. It's like, 'cause it seems like it's very significantly better than expected.
That happens, yeah. It's just people do their best to try to estimate where it's going to end up, and
I know it's a good thing, but it's it's just surprising that it's so off, I guess.
Well, that's what these reports are all about.
Yeah.
People try to estimate what they think it's going to be at, and then the government comes out with their real numbers, and people are surprised or they're not.
Yeah, that's really good, though.
But,
people aren't as bad as...
Despite all of that, and we're still over 10% unemployment.
Yeah.
That's still the highest it's been for literally decades. So positive numbers, in comparison, but not like super positive,
Yeah, that's true.
So it's not great, but it's how it is.
It's something.
It's something. So yeah, that's the economic data for this week. And like I said, we'll kind of see how it goes next week. The first week of the month is always really active that way. But I'm curious what next week will hold, just because this week, 2 or 3% upside, gains for all the indices. That's kind of insane, in my opinion. So we'll have to see. For my own trading, I had to close out a few losing trades. I'm trying to think which ones right now that I don't remember.
Didn't you tell me? No, I don't know if you did.
I may have. I did have a winning trade on...
Yeah, you did.
Merck, MRK. I had an Iron Condor on that. That's been up for like a month and a half or something. I don't remember if I mentioned that Monday or if it was later on that happened.
No, it was after.
Yeah. I had a lot
I think it was Wednesday.
It might have been.
Yeah.
So I had an Iron Condor on MRK that closed out really well. Oh, losing trades. I got crushed by, what was my earnings? Oh, you know what? That was Facebook last week. This week I almost did Beyond Meat, BYND, and I didn't. And I'm really glad I didn't, because it was a really close call.
Ooh.
So that was good. I didn't really... Square, I was going to play earnings on Square, like I mentioned on Monday, but there was some kind of data leak, and they released their report a day early, because somehow people got access to the data. I don't know what all the details are around that, but...
Oh, no.
Yeah, Square released their data on Tuesday instead of Wednesday, I think it was. So that was interesting. And but otherwise, yeah, I had a pretty good week for different, like I said, MRK. I had an Iron Condor on. What else did I have? ET is a stock. I had 2 positions on that, put credit spreads. That I had a what's the name of that stock? Because I can't remember.
Phone home.
I was waiting for you to make that joke. Energy Transfer LP. So I did really well on that this week. Had a few other positive trades, and I have a lot that are still on. So just kind of seeing where things are going. It's been rough for call credit spreads because the market just has been going insane. I did close out my SPY call credit spread that I recommended on here because that was just way in the money. And AMC did close out successfully.
Oh, that's right, you did AMC.
Yes, AMC did close out successfully. So yeah, those are a few of my trades. I don't have a full list of which ones I did, but those are a few of them. I did a new one yesterday. And I don't do this too often, I did what's called a call calendar spread. Maybe we'll talk about that one day. A calendar spread is basically, it was for AT&T, ticker symbol T. Basically, I bought, so the stock is trading around, let me see, almost $29.98, almost $30. I bought a $30 call for October, and I sold a $30 call for September. So it's a horizontal spread, if you can imagine that. It's the same strike but across months. And I hope
you lost me.
It's horizontal because if you imagine months like in a line, you know what I mean?
Oh, okay.
It's horizontal at the same strike, and it's called a calendar spread because it's across months. Let's say you sell a $30 strike or call for September, and you buy a $30 call for October. That's what I did for AT&T.
Oh, weird. Okay.
I'm kind of curious. It was only 26 cents it cost me. So, the idea is that if it stays around $30, that the short call for September will decay faster than the long call for October. So that's kind of, AT&T hasn't been moving around too much. It's been kind of hovering around $29, $30. So something new I wanted to try out. I haven't done too many of them. It's a debit spread instead of a credit spread, but it only cost, like I said, 26 cents. So it was kind of, let's see what happens.
Yeah.
So,
Did you ever do, because remember, you told me, was it on Wednesday, that you wanted to play with an earnings report, but you were too nervous to? What was that for?
Oh, that was Beyond Meat. I did not.
Okay.
I did not do
Good
it.
thing.
Yeah, it would have worked out, but what happened with Beyond Meat is it was at 142, before the earnings, and then after the earnings, it dropped all the way down to 130. The next day, it kind of hovered around 133 or so, which was fine. That would have been inside my range, but it's not worth the the stress of that. It's, if I'm not really sure about it, So earnings are a little bit, they can be a little bit stressful.
Yeah.
I didn't. The reason I didn't want to do that one is it had gone up like 15% over the last 2 days, so I was nervous about really putting on any sizable position on that because it had been going up so much already. So
that makes sense.
Yeah. All right, so that is our week in review. That's, like I said, we've had a really positive week in the market somehow, and we'll just kind of see where things end up next week. So we will now get into our main topic. Investors versus traders. So this was actually what we were going to originally talk about Monday, but we swapped it around since I thought we were going to have our interview today. So basically, and I've alluded to this in the past a little bit, but there are a lot of different ways of investing. The very, most basic way of investing is just basically buying ETFs, index tracking ETFs or index funds or things like that. This is mostly like what you do in a 401k or sometimes in an IRA if you don't want to really think about it too much. Or, if you just want to put in money and not really think about it at all, you just maybe buy the Vanguard Total Market Index, VTI, or, something like that, and leave it, or you might diversify over a few ETFs if you want to, but this is kind of the most basic way that people invest. And that's, when I first got into investing, it was kind of drilled into my head from all these different sources. Like, this is the only real profitable way of investing because the market always goes up over time. And, you can't beat the market and blah, 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 whatever. And then, I got into picking individual stocks and just, going long on individual stocks that I thought were going to go up and holding them for a period of time, ideally a matter of years if possible, if I believed in the company. And that has its own proponents, people who believe that's the only way or that's the best way. And then from there I got into more what you would call swing trading, swing trading is different from day trading because day trading is where you trade within a single day. Like you might buy or sell something the same day. I don't do too much of that. But swing trading is where you might hold something for only a couple days or a couple weeks at the most. And so I got more into that. And, with options, you can do that with stocks too, but options are really perfect for that. So it kind of illustrates a few different ways of trading, but the main two categorizations that people talk about when it comes to investing are investors and traders, as the title suggests. So, Christine, would you have any idea what the difference is?
No.
Okay. I wouldn't. That'd be good to ask Christine, but if you have no clue whatsoever, then I won't even go there.
No, I have no idea. I mean, investors invest and traders trade?
Okay. And so...
Yeah, so what's the difference? Like, who cares?
All right, so the basic difference is that investors tend to be more long-term.
Ah.
Whereas traders are more short-term.
I should have probably known that.
Yeah.
If I really thought about it.
Yeah, it's not that hard. I'm just kidding. It's okay. So investing is where you might say, okay, again, this is where the index funds come in or the ETFs or whatever, where you just are kind of hands off, maybe you rebalance your portfolio once a quarter or something like that. And you leave it at that. Maybe you have like an allocation of, let's say 80% stocks, 20% bonds, or you might have some international or some, whatever, small cap or mid cap or large cap. But overall, you kind of leave it to the ETFs to figure things out, and you don't worry about it too much.
That would be me.
Right.
I would be an investor.
Yes, yeah. And
If you weren't, like, around or something.
Yeah.
Or I didn't know you, or...
Right. And that's, what most people will do. And to be fair, if you don't know what you're doing, that's probably what you should be doing, because otherwise you will probably lose.
Mm-hmm.
So, this also includes, like I said, picking individual stocks. Maybe you really believe in Apple, or you really believe in Microsoft, or in Facebook, or in, a lesser-known company, maybe. And so you buy some of their shares. Maybe you dollar cost average into it. You put in a little bit every month or every couple weeks. And you just let it grow over time, right? And obviously you do more than one stock. You might do like 10, 15 different stocks that you really believe in the companies, where you're not really investing in the stocks per se. You're investing in the companies. Like, you are doing it because you want to own part of that company. You believe in what they're doing, and you keep up with, how much progress they're making and how they're doing, and, whether they're reaching their goals, and so on and so forth. And this takes a bit of work. This is more where you want to research fundamentals of a company. You want to look at what kind of product they're actually producing, what their goals are, how their profitability is, that kind of stuff. And there are, people who follow portfolios that kind of do some of that work for them, but it still takes a bit of research if you want to do individual stocks. But the goal of investing is that you're going to put money in and really not touch it for a period of years, okay, and hope that it grows. Now, the upside of investing is that, well, if you're doing ETFs, it's easy. You might choose, 2, 3, 4 ETFs and, pick an allocation and stick with it for years. And you might look at your portfolio once a quarter and maybe allocate things around to make sure you're meeting your percentages and so on and so forth. But otherwise, you're not really touching it, right? So it's really easy. For individual stocks, that does take more work, but again, selling isn't really on your mind. On your mind is just, is this company still doing what I believe it should be doing? Is it meeting its goals? Is it increasing in value? Is it returning profit to its shareholders? And you might follow up with the earnings calls and that kind of stuff. You might look at the fundamentals, and but really, unless something big changes where a company you once believed in has gone off the rails a little bit, you're really not going to sell until years down the road, right? So a lot of the work with individual stock investing is finding a good company, and then once you found it, you just keep adding money into it, right? So that's kind of the upside. It's pretty simple as far as that goes. And, most good companies are going to increase in value over time. I mean, no matter if we have pullbacks or crashes or bear markets or whatever we might have, over a period of years, the market does always go up. And so if you've chosen good companies to invest in, then, they're almost always going to go up in value.
Why does the market just always go up? Like, how do we know that inherently?
Well, we know that because it always has happened, first of all. If you go back all the way to the beginning of, our current U.S. stock market, it always has gone up over time. If you widen the picture enough years, it's always been going up, right? And so that's even with the Great Depression, even with, the crashes we've had periodically, even with the dot-com bubble, even with the 2008 crisis, it's always gone up over time, right? Okay. Now, it might take years to recover from those sorts of things, but it has always gone up. Why does it always go up? I think a lot of it is down to the companies that make it up. Companies are always working on growing. Who's going to invest in a company that's going to be worth less next year than it is this year?
True.
Companies are always working on growing their earnings, on growing in value, on returning greater value to their shareholders, and so with that happening, with companies competing and growing in value, I mean, the market just rises over time. It's called positive drift.
Okay, so there's never been a negative drift.
Well, again, in a short period of time, you might have a year or 2 or 3 where it does go down.
Mm-hmm.
But, like I said, 2008 is a good example.
Right.
But, over time, it always goes up.
Yeah.
If you broaden the picture enough, it always goes up. So it's not even a question. If you invest something today, then chances are that in 20 years, it's going to be worth more than it is today. Now, how much more? That's the question.
Yeah.
Right. I mean, on average, it's been about 10% a year, 9 or 10% a year. Over the last 10 years, before this pandemic, it was a lot more. There were some years where we had 26% upsides. And obviously there are some years where it might be only a couple percent, and there's some years where it's negative. But over time, it kind of averages out to about 10% or so a year. And so that's what we kind of assume it's probably going to be in the future. I mean, obviously you can never tell that for sure, but it's probably going to be so. And so that's, again, the upside of investing is you're pretty sure that if you put money into a good company today, that it's going to be worth more in 20 years, right, than it was today.
Well, yeah.
Right. And with companies, you want to, reevaluate that every once in a while because you have, companies kind of go out of style or other companies take their place or they, might go into bankruptcy if things really go wrong. I mean, that happens. I mean, companies that previously we might have thought would be around for decades pretty soon, are no longer that popular. So with individual stocks, you kind of have to do your due diligence and really look at it. Is this company still on track or is it not? Is my money better spent elsewhere or better invested elsewhere, or is it good here? And so that's the thing with that. But the nice thing about ETFs, let's take the S&P 500 as an index. That's the top 500 companies in the U.S., right? And the thing about that is that it's always going to be the top 500 companies. So if a company does poorly, it'll fall off the index, and another one will take its place.
See, that's really cool.
Right. So it's always the top 500 companies. And so as they do well, the whole index goes up. As they do poorly, they fall off the bottom, and another one takes its place. And that's happened, Same with like the Dow. The Dow replaces some of its components regularly, That's like the top 30 big large cap companies. So that that happens where like the S&P 500, you're literally investing in the 500 most successful companies in the United States. Right, so there's a lot to be said for that. The downside to investing in that way is that you might be giving up some profits. All right, and it depends, obviously. But if you're doing it the traditional way, 10% a year is what you have to expect. That's great. But, and that compounds rather quickly, obviously. But, arguably speaking, if you become really good at trading, or if you get really good at options, you can way outpace that. Now people will argue, like very traditional investors will say, no one can beat the market in the long run, But there are definitely people who do. And with options, you definitely can, which is why I love options. But that's kind of the downside. So you are getting a profit. You're definitely going to get some sort of profit over time. But you might be not getting the full profit that you possibly could if you just go with investing. And that might be okay for some people. Like if you're just working on retirement, if you're just saving for retirement and you don't really care about how well it does, you just want it to grow over time and be there when you need it, that's great. Let's say like your average 401k where you're putting in money every 2 weeks or something. You don't want to look at that. You don't want to think about it. You just want it to be taken care of. You might choose a few index funds, and then that's it. And you just want it to grow over time, right? So that's fine. But if your focus is on, I'd love to learn how to maximize profits, there's only so much you can do with pure investing, right? Even if you select like really good companies, you might outpace the market. You might outperform the market, but it is really hard over time because it's just hard to know which companies are really good companies, right? I mean,
Right.
Today it might seem obvious. We have Apple, we have Amazon, we have Microsoft, but where will they be in 10 years?
And I feel like it's like if you want the control, you trade.
Exactly, right.
But if you just want to be like, set it and forget it, then you invest.
Mm-hmm.
And there are people that really want to learn how to do this stuff and how
Right.
to get, well, I don't want to say rich, but
Well, I mean, that's to build wealth.
Right, to build wealth and to have that control.
Yeah, that's the goal, is to build wealth, so.
Mm-hmm. No, but actively doing it.
Oh, sure, yeah. Yeah. So, trading, on the other hand, and there's all sorts of ways this can go, but whether it's day trading, swing trading, or whatever, it's obviously a lot more active. So with trading, as I said, you're only going to be holding something for maybe a matter of days, weeks, or maybe a month or two at the most. And you're looking maybe not as much at fundamentals. You might be, but that's more for the investing side. You might be looking at momentum. You might be looking at the trend. You might be looking at the growth, the expected growth of the company, how analysts are rating it, things like that, or just pure chart patterns. You might be looking at RSI. You might be looking at Bollinger Bands. You might be looking at MACD. I mentioned the other day. There are tons of different chart patterns and technical indicators and whatnot.
What are Bollinger Bands?
Bollinger Bands. Yeah, one day I'll talk about these. It's basically. I'm not going to describe it right now, but it's a way of seeing. It's like two lines that surround the price, and if it's at the upper end of the band, then it's probably overbought, and if it's a lower end, it's probably oversold.
Okay.
I'm not going to go into the details
Yeah.
today about it, but that's basically what it is. Obviously, moving averages, that's a really common one. That can be used for longer term investing too, although not as much. But there are tons of technical indicators, chart patterns. I mentioned this on Monday, that traders will tend to use to kind of see where is this stock probably headed in the short term. I might not even care what their product is. I might not even know what they do per se. And people are different. There are some people, like I mentioned, I'm subscribed to Zacks, and I follow a whole bunch of different portfolios there. And some of the analysts there will tell you, why they really believe in this company and why it's really good, and why they're really well positioned in their market. But they're still sort of short term. They just really believe in that company. Whereas others will just say, hey, this is due to break out above this level. It's really well set up on the chart, so we're going to do it. And maybe we'll look at the sector, maybe we'll look at a little bit like that, but they don't really care what the company's doing per se, right? So you're not really looking at the company as much as the actual stock and its price action and how it's performing, and things like that. So that's the big difference, is where your focus is. Now, if you are doing options, again, you're going to have kind of a core list of ticker symbols. Some of them will be ETFs, some of them will be stocks. you might play earnings, whatever, but you might not even care about the chart. Like on a Tasty Trade, they don't even look at chart patterns. They don't even look really at technical indicators at all.
Oh, really?
No. They just look at probabilities, because options are all about probabilities. So they'll look at, really what they look at is volatility, the volatility rank, which I'll talk about one of these days, and whether they can get a good price for the options, a good credit for the options, and that's about it. They don't really care too much about what the company, or if at all, about what the company's doing. In fact, they just said the other day, which I found really interesting, they like to stay away from companies, that are actively in the news, because, when a company is kind of in the news and people are really looking at it, the price can act very differently than if it's just trading normally.
That makes sense, because the media has a spotlight on it.
Right, and people are saying, oh, maybe it'll do this, so we'll buy it up, and you just don't know what's going to happen.
Yeah,
right?
That makes sense.
So, like, if you have, like, a drug company that just came out with a new drug, or, like, let's say they're making progress on the coronavirus vaccine, we might stay away from that for options, because we just don't know what it's going to do. It's too unpredictable. But normal day-to-day trading of stocks that maybe aren't really focused on too much, they act generally pretty predictably, right? So, so with options, you're not even really looking at technical indicators or chart patterns or, any of that kind of stuff, moving averages or anything like that. You're looking at volatility, because as options sellers, we want high volatility. And you're looking at just the probability of the trade that you're putting on, whether it's an iron condor, a strangle, a call credit spread, a put credit spread, whatever it might be. It doesn't really matter what the individual stock really is. Yeah. And you've seen, I've said, I traded ET, but what the heck is ET? I don't remember. And then I look it up. Oh yeah, that's what it is.
Oh yeah.
Because I don't look at the company. I couldn't really care less what they're doing. I remember the reasoning on ET is I heard someone talking about it a few months ago, and they said that, the company's done really well overall. They've been pretty bullish. And I traded it once a few months ago and went really well. So I remembered it recently, and I'm like, oh, maybe I should try another trade in there. And it worked. But I don't even know what the company's doing. I couldn't tell you. Right? So that's how options work. But so the upside of trading, of short-term trading, is that, number one, there is a much higher possibility of profit, making a lot more profit. I mean, now this one you have to be careful, and I've talked about this before. You will see people who say, yeah, I made, 100% in my account in the last month or something. These are new traders usually, and that's not sustainable. That's not going to happen. But you can make more profits overall with short-term trading if you're good at it than with just trading, or investing in the market itself, or investing in individual stocks. So, I've seen people do really, really well with options, whether they're buying options or selling options. It just depends. Selling options has a higher probability of profit, as I've said in previous podcasts. But, whatever you're doing, short-term traders have the possibility of profiting more. Now, whether they actually do depends on how good of a trader they are or how good their strategy is. So with trading, what you want to do is you want to find a good strategy. And once you find that, you stick to it and you trade the strategy. You don't try to make up your own rules and that kind of stuff. You want to find a strategy that works, stick to it no matter what, and kind of make the decisions very mechanical. That's what we try to do with options and with trading in general. So
could you do both? Investing and trading? Like, is that...
Yeah, you could for sure. And I'll talk about that a little bit in a little while, because I want to finish off with trading. But yeah, you can
sorry.
definitely do both, for sure. Remind me of that topic, because I do want to get there.
Okay.
But yeah, you can definitely do that. But with trading, you have the possibility of profiting more.
Mm-hmm.
Whether you actually do is the question, right? There's no guarantee of it, and there are lots of traders who fail. But you do have that possibility. And it's kind of the promise that pulls people onwards. They want those big profits, and a lot of times they take too much risk and they fail. But if you know what you're doing, and you manage your risk, and you manage your position sizes, and you follow a working strategy, you will more than likely succeed. Right? That's just kind of how it works. So the other upside is, and this is subjective obviously, but it's enjoyable. I love trading. I love getting into the markets and looking at what's going on, and sometimes it's really frustrating, and that just happens. Sometimes you'll get into a trade and it'll immediately go against you, and that's really frustrating. Sometimes the market just doesn't make sense, like it does right now, and that's really frustrating. But for certain people, and I think to be a good day or swing trader, you have to enjoy it. You know what I mean? Like, if you don't enjoy it, why would you want to put in all the work? Because it does require a lot of work, right? But for me, it's enjoyable. I love, I hate that today's Friday.
I know, you were complaining last week. I don't want tomorrow to be Friday.
Yeah, so, I don't like Fridays. I love Mondays.
And he hates when there's a long weekend.
Oh, I hate it,
or,
yes.
like, Memorial Day will be coming up. Or Labor Day.
Well,
sorry.
What month are you in?
I get the two confused, okay? Labor Day. One of them is coming up.
Yeah, on our
soon.
vacation.
Yeah, well, I know, but you'll still be upset. Because I know even on vacation, you're still going to
Oh, of course, obviously.
See?
But, with a trader, you really can't keep a trader from the market. I mean, no matter how many times they fall, and this is the sign of a good trader, in my opinion, no matter how many times they fall, they're going to get right back up and keep trading.
Yep.
You just can't keep a trader away from the market.
No.
Right? It's just in their blood. And that's, I picked the absolute worst time to really get active with trading in the midst of the coronavirus pandemic and this whole meltdown of the market.
Well, didn't someone tell you if you can trade now, then you can do it in, then you really know you can do it.
Then you're really set, yeah.
Yeah.
And that's true. But, with all of this going on, even though I've lost at times, I've lost big at times, it's gotten really frustrating at times, but I couldn't not do it. I just couldn't not trade. That's not possible. So, I always look forward to Mondays. The weeks never last long enough. It's like, oh my gosh, it's Friday already. And
they should have weekend trades.
I know. Well, I mean, Bitcoin, I guess, but Bitcoin is like crypto.
Well,
but
that doesn't count.
No.
Bitcoin should not exist.
But, it's just traders are going to trade, right? You can't. I think everyone should at least invest, but if you enjoy trading, you're going to trade.
Yeah.
Just do it smartly. So downsides, I mean, it takes a lot more work, obviously. Now, this depends on the type of trading. I mean, stock trading takes a ton of work, especially if you're a day trader. You're literally relying on maybe a few cents of profit at a time that you're going to grab onto. You have to act like instantly. And that's not really my thing as much. It's too much stress. But I know day traders, that's a very stressful thing where you have to really look at the charts and find the best entrance and best exit and jump on it without hesitation. And you might only get like a few cents at a time, but that's what they call scalping. But that's what you get, right? And so it's a lot of work and it's stressful. But even for swing traders, you have to look at which stocks you want to get into, and you're not looking at the value of the company. You're looking at overall, does the stock do well? Maybe it's at the lower end of its range for no reason, or maybe it's overbought, and so I want to short it. And so you want to look at what the stock's doing, where you think it's going to go, form an opinion, and perform the trade. Now for options traders, it is a bit easier. Not going to say less stressful, because you still have things going against you. But for options traders, you don't have to necessarily sit there all day, especially if you have a good system where you're taking like 50% profit or whatever your profit target is, and you have an automatic order to do that. But, if you have a good option trading strategy, then you might only have to look at it a couple times a day, but you do have to stay on top of it, So it's a lot more active than any form of investing. And you're looking a lot more not at the company, but you're looking more at the charts, at the numbers, at the probabilities, and all that kind of stuff, right? So it's just a lot more work. And again, is that a downside? It just depends on who you are. If you really enjoy trading, it's not really a downside. Right. Other downside, I would say, is a lot more risk. With investing, you pretty much know that over time you're going to succeed as long as you choose good companies, or if you're in a good ETF or index fund. But with trading, you can lose big, and it can be very quick. So there's a lot more risk. Now, risk management, one of these days I'm going to talk about this more, but risk management is one of the biggest things you need to address up front. What's my risk management strategy? And if you have that, then you're pretty set. But if, what's really hard with trading is when we're losing, we don't want to cut our losses. And when we're winning, sometimes we take profits too soon, and sometimes we hold it too long, and then we lose our profits. So that can get really infuriating. So you have to have a system of risk management, of when am I going to cut losses, when am I going to take profits. And you have to stick to that religiously, right? So emotionally, it can be very, very draining, because when you're losing, you're just like, oh, it's like the gambler's mindset. If I just hold on, if I just keep doing it, it'll turn around, and I'll recoup my losses.
Yeah, and you can't, that's not helpful.
And that's not always the case, and the more you try to do that, the more often that it won't.
It's like the slow and steady thing.
Right, exactly. So you have to have a good risk management strategy, but, risk is the biggest issue with short-term trading. You have to get that under control, and if you do, then you're pretty well set. So that's really the difference between investing and trading. Which one you choose is really up to your own style, your personality, your preferences, how involved you want to be in the market, that kind of stuff. And so you were asking earlier, can you do both?
I was just going to remind
you. Yeah, and of course you can. You can, and you might have different goals. You might have a 401k, you might have an IRA. And by the way, you can do short-term trading in IRAs too. You can do options in IRAs. You can't do undefined risks. You can't do like short strangles or naked calls, naked puts, that kind of stuff in an IRA, but you can do defined risks. So iron condors, call credit spreads, put credit spreads, any form of long option or debit spreads. Those can all go in IRAs, which I found very interesting when I found that out.
I never knew that.
Yeah. So you can do that in IRAs, but you may want to be more conservative with your IRAs, if that's your retirement funds. But you might have different goals. You might have this amount of capital for retirement that you maybe want to do more of investing with. And you may have another part for just general wealth building, or maybe you're saving for a house, or maybe whatever it might be. And you might want to be more aggressive with that. So you just have to kind of look at the goals you have with your money and decide what's the best style for this goal, right? And so personally, what my goal is, I like to have a mix of of styles. So for capital that I just want to preserve long term, I might do more of the investing style. But even I might split up trading a little bit, where I might have a portion of short-term stocks. Maybe I'm following a portfolio I really believe in, and they recommend a stock that I'll get into. So just short-term stock trades, maybe a few weeks to a few months. And then for me, the majority of what I do is options, right? So that's usually about 50%. But those are, I kind of split it up into three parts, where part of it is investing for long term. Part of it is more short-term stocks, where I want to see where the company goes. And part of it is options. So, there are lots of different styles you can get into, and you can kind of see what works best for you. There's no right or wrong. It's a balance of risk and reward, of, profit potential. And you have to kind of see what works for you. So, it doesn't really matter. It just depends how aggressive you want to be or how conservative you want to be. And you might do a mix of them, right? But if you know what's out there, if you know what the options are, then I know. Then you can decide, okay, well, maybe I want 100% to be conservative, or I want maybe 30% conservative and the rest to be more aggressive, or whatever it might be. But you can decide that based on your goals and how much money you have to spare too. I mean, if you only have enough to be aggressive with and you want to try that, then you might do that. But there's no right or wrong. I'm not going to tell you should definitely invest part of it and only get aggressive. Like some people will say, 90% you can do in ETFs and index funds, and the other 10% you can have fun with. And that's fine for them if that's what works. But there's no right or wrong in my opinion. I think it all just depends on what your goals are and what your style is and how involved you want to be with the market. Like Christine said, if she was getting into this, I think she would only do investing.
Yeah.
Right.
It's over my head, unless I have someone else do the trading.
Yeah. So, I mean, that's just kind of how it goes. So, yeah, that's the difference between trading and investing. I know it's not the most exciting topic ever, but I think it's really important to know.
Yes, it was, because there's no numbers.
Oh, actually, there's
a nice, easy topic.
Yeah, so, but, I just want to talk about, or I wanted to emphasize, like, what styles are out there so that you can tell for yourself what you want to do. And I'm willing to answer questions if you have them about this. You can comment on the show notes, which I'll talk about in a second. But you have to decide this for yourself and execute your plan. There's no one that's going to tell you this is right, this is wrong. Or people will, but they're wrong because it's all up to you. There's no right or wrong in any of this. So hopefully that helps. And, I'll be going into more detail about a lot of this in the future, but this is just kind of a surface level just to show you what's available. Obviously, my focus is more on trading, so, if you're following this podcast and Possible Promise in general, that's kind of where I go. I don't really do too much of the longer term because that's not my style. So, hopefully that helps. And if you do want to see the show notes, you can go to possiblepromise.com/15. And that's where you can see the show notes. And you can also leave comments there. Always love to receive your comments. So otherwise, we will... Oh, before I announce that, if you want to ask a question for the Possible Promise podcast, you can go to possiblepromise.com/ask and submit your question there. So I hope that everyone has a wonderful weekend. Unfortunately, it's Friday, but we will be back on Monday for another episode of the Possible Promise podcast. Thanks, everyone, and have a wonderful weekend.
Have a good weekend. Bye, everyone.
Bye.